I'm going to Charleston this weekend, so I'll have some just like adult creatures.
It's like, doesn't mean like. I know.
Riding the bus this weekend.
Taking the bus to Gulf Shore.
Yeah.
That.
And no, it's at Dallas,
Oh,
same thing though.
Yeah.
I'm going to my trade formal for fun.
Cheap flight.
aren't you a grad?
Oh, I graduated a year early.
We hang out.
Yeah.
Maybe some shenanigans in Dallas.
It just sounds like the Dallas.
Yeah.
I saw the Creed to do last night. We watched the Rocky. I would say like the new one. Pretty good.
I never saw Creed.
Yeah, makes you want
I never saw Creed.
to. Yeah, no, I'm gonna be a pro boxer now.
You come out this week.
I think so.
Awesome. Great cardio. I would know about great cardio. Yeah, cardio and abs.
Oh, that's gonna be a strike. Keaton's gonna drop you 10%.
Yeah, you look at the punches, other than
I
that,
work
like,
off, but I have more training, but I have the in-person meeting stuff tomorrow morning. I was like, I'm not driving. Do that
Exactly.
and then drive back. I did that last week.
It's pretty good.
Yeah, for my dad's class, we got it on that.
Well, yeah, because I sent that email out and he was like, I have to do one class.
Because no one's going to class.
I know, but then that would be me.
I had like a stretch for like a month where I didn't go to mock class. I just stopped going to class.
Good at tennis, I'm the only person in class.
Yeah, I feel bad. It's like I just
Relax. I might have like a.
It was cold and I didn't really want to run.
Portfolio, we actually picked one website, like online, Denver, I think my dad put it was like forever,
Yeah.
people was art go.
Yeah.
Wanted to do profit class.
He didn't take it or he didn't.
Exactly.
He'd be like,
My dad had a question.
Yeah.
Chiefs was the answer, just to go on the board, just to prove that we were taking the test. On campus. And so I wanted to get the test, not the first. And so he wanted something that someone who sent a text.
Okay, now we're gonna talk equity recognition and owner financing, unless one of you has a better suggestion. Then we can talk about whatever you want, but it's your time, you pay me your time. It's been 2 weeks. I was out of the country for one of those weeks, so if you tried to get hold of me, you did not. That was an unsuccessful attempt, and I don't feel sorry about that a bit, because we were celebrating our anniversary on the beach, and so I learned a thing or two. My wife suffers from depression, and a component of that is seasonal. So the doc says you would be smart to get out of town and go get some sunshine. So second or third week in February, we try to get out of town. So I'm trying to be a good husband, and I'm online and I'm searching places to go, and I find a spot in Cancun, and I'm like, I'm gonna pay up a little bit. So I booked what I thought was a nicer resort, extra husband points. Come to find out, I booked an all-inclusive. So instead of booking at the high end of a regular resort, I booked at the low end of the all-inclusive experience and and got to spend our 3 days in Cancun eating 1/8 of an inch ribeyes and watered down margaritas, which is no problem if you know how the system works, which we didn't, but we quickly learned because everybody else at the resort had their own Yeti cups that they'd carry around with them. So they walk into the bar, they ordered 3 margaritas at the same time, they dump them all in their Yeti cups and then go back to the pool. So if you've never been to an all-inclusive resort, which I have not, bring your own Yeti. Probably more valuable than anything else you'll get out of tonight's lecture. So just remember, bring your own Yeti cup to the all-inclusive resort. All right, hit me with questions. We're 8 weeks into this class already. We got one exam underneath our belt. The scores came back consistent with every other time taught this class, so that's great. We're right on schedule. And this is my opportunity to remind everybody how the syllabus is designed. Those exams, they separate the A's from the B's a little bit, but even if you got a mid-70s grade on that exam, if you look at all of the other points available in class, you're on track to get an A. There are so many homework points in this class, and there are so many points associated with that year-end semester research project. That's exactly where you want to be if your goal is to get an A. And I don't want that to cause any alarm bells. You know, nonetheless, here we are, week 8. I've already posted the second exam out there. Format should be familiar to you at this point. Practice exam should be available. That exam is going to be open for the next 2 weeks, starting tonight. It'll close at 11:59 p.m. midnight, 2 weeks from tonight. So that's your window. Go out there and take it anytime. And my update. So what questions do you all have before we jump into module 8? Okay. I'm gonna take that as an indication that everybody's on track or asleep or doing good. So tonight, we're gonna talk about equity recognition and owners financing, basically the bottom half of the balance sheet. We've been kind of working our way through the major financial statements and talking about the accounting that works its way into those estimates of the reporting and revenue recognition and some of the other unique accounting aspects that give me the opportunity to play that little unifying penny. And tonight we're going to take a little bit of a deeper dive into some of those components that you see on the statement of owner's equity and the bottom half of the balance sheet. Talk about stock-based compensation and half a dozen different programs that are wrinkles, different versions of stock-based compensation. You all have had an opportunity to take a look at the proxy at this point. You know how your management teams get paid. This might give you a little bit of insight into how some of those programs are defined. Then we're going to touch on some of the major components of stockholders' equity, preferred stock, common stock, convertible features associated with preferred stock, stock splits, stock dividends. My expectation is that most of you all have probably encountered this at some point in your block school experience, so a lot of this will be review. So let's get into it. And we'll talk other comprehensive income. That might not be a review. Other comprehensive income doesn't show up in most curriculum. Shows up here in a big way because that's where you can hide, that's where you can obfuscate a lot of the accounting associated with some of those big items that FASB deems to be one-off in nature or unusual or frequent in such a way that we want to put them below net income. I think you've probably heard me refer to this as the basement before. We want to put this below net income in the basement so nobody pays attention. We as analysts know where to go to find it. And if you've seen this used frequently, you know that that might be an opportunity to find some hidden value on the balance sheet. So we'll talk about that. And before I do anything, I have to turn this. So, okay, very high level. Our authors start off by sharing Jonathan and Johnson's equity section of the balance sheet. And I want to talk about each of these major components: preferred stock, common stock, accumulated other comprehensive income, and retained earnings. Our author's going to take us through one by one and define what each of these are. Preferred stock is contractual. And what do I mean when I say contractual?
It's like obligation to pay it back.
It's an obligation to pay it back, but it also can take almost any form. When I use the word contractual, I want you all to think about contract law. So everybody had contract law over in the law school? Not very many of you have had that class yet. It's a terrific class. Take business law, a big component of business law is contract law. And that's the foundation that our founding fathers used to build a capitalistic society. You know, any free person can enter into a contract with another free person. We ought to be able to sit down, define the terms of that contract, have it signed off by a witness, and then be bound by that inside of our legal system. So when I say preferred stock is contractual in nature, I mean it's bound by contract law, and the terms associated with that preferred stock can be basically any terms that your management team wants to define. They put those down on a piece of paper, they issue a memorandum or a prospectus with that, and now that's part of the public domain. So you as an investor are basically held responsible, you're accountable for knowing what the terms of that are. Now, generally speaking, convention is for preferred stock to take the form of an equity unit, and it's typically senior in the capital structure to common stock. So if the company goes bankrupt, you're going to be paid back where the common stockholders are. But beyond that, it can have any features associated with the dividend, preferred dividend, cumulative dividend, convertible rights associated with those dividends. And management can draft that language so that they can pay that dividend or withhold that dividend. They can make it more attractive for the stockholder, the preferred stockholder. They can make it more attractive for the management team. In other words, the common stockholders. I love the contractual nature of preferred stock. I love the contractual nature of options. I love the contractual nature of bonds. It's a headache as a student because it's so complex and esoteric. But as an analyst, as a profession, that's where all the opportunity lies. If you want to do the heavy lifting of digging down into some of that contractual language to find out where the real opportunity is, this is a great place to look. Because oftentimes you'll find these issues very thinly traded. And when they're very thinly traded, it means that the major brokerage houses and mutual fund companies, they can't buy a big enough slice of that to make it worth their time to even bother looking at the features of the investment. So if they're not looking, that creates opportunity for the smaller investors to look around, find investment opportunities and deploy capital, sometimes at more attractive rates than even the big investors can on Wall Street. So that's how I conceptualize preferred stock. And if you have preferred stock on the balance sheets of the companies that you're working on this semester, take a look at it. What you just might find, and I've run into this a handful of times in my career, you just might find a thinly traded preferred stock issuance that's more attractive than the common. So the framework that I want all of you to be using and asking yourself this semester is, would I invest my own money in this opportunity? So we're going to ask that question of the common stock. But you might find yourself in a circumstances where the answer to would I buy the common stock is a no, but the answer to would I buy the preferred stock is 100% yes. So if Johnson & Johnson is trading at $80 a share and you think it's worth 60, you're probably not going to buy that common stock. But if Johnson & Johnson's trading at $80 a share and they have a preferred stock outstanding that's going to pay you 8% interest and give you the right to convert that preferred stock at when and if the price ever hits 80, well, that's a different proposition altogether. Because now as an investor, you're thinking to yourself, okay, well, I can buy the preferred and earn 8% on my money. And if Johnson & Johnson ever hits 80, I have the opportunity to convert it. And if it doesn't ever hit 80, I'm pretty happy with an 8% rate. Those are the types of trade-offs that my clients are very, very interested in because most of them are saving for retirement. So you got a big blue chip Johnson & Johnson name paying a healthy dividend at 8% with a preferred preference in the capital structure. That means we get to offload a little bit of that risk associated with bankruptcy, even though it's remote because it's J&J. That's the type of investment thesis and proposition that a lot of investors are going to be interested in. And I suspect that some of you will run across that. Okay, common stock, typically on the balance sheet, you're gonna see common stock recorded with a par value. I wish that would just go away. It's anachronistic. Par value doesn't mean anything anymore. State law used to dictate that anytime you issued common stock, you had to say it was worth something. You had to publicly print on the stock certificate that it was worth some nominal value. So most of the time you see $1 or a penny or a tenth of a penny. That's gone away now. Convention dictates that par value exists for most of these companies, especially like Johnson & Johnson, been around for 50, 100 years. But you might not necessarily see it for an IPO. Just know that par value is typical of a brand new issuance. In this case, it's $1 per share. And then a company goes to the public markets and they sell that stock. And they're going to sell that stock well in excess of par value. They're going to Johnson & Johnson here, they're going to sell that stock for $80 a share. So while they have that line item on their balance sheet that says so many shares at $1 a piece, par value, everything in excess of that they generate through the sale of shares shows up on the very next line. Accumulated other comprehensive income. This is where most of the equity is maintained, and then you have retained earnings. So look at J&J here, $106 billion in retained earnings on their balance sheet as of 2018, because they've been in operation for so long. Just so that everybody's on the same page, I want you all to conceptualize stockholders' equity as nothing more than owning a portion of the business. So if we all got together and decided we wanted to launch a business, what do we want to run? Pizza shop, beer hall, car wash. Your preference. You don't. Okay, so we own a pizza shop, and we need $1 million to start that operation. Well, we're gonna divvy that business up, and we're all gonna chip in. Looks like there's probably about 20 of us in class, so we're all gonna chip in $50,000. So $50,000 buys each of us a 5% interest in that business. When we take it public, we're gonna issue shares of stock. We're gonna issue shares of that business to each of us in this room. So if we issue 100 shares, we each get 5 of them. That's our claim on the assets of that business. That's our claim on the cash flows of that business. We're owners. We need to think like owners. We need to act like owners. Stockholders' equity. I think sometimes investors especially get confused about the notion of stockholders' equity. They get confused about stock, and they fail to grasp the concept that this is a business, and as a stockholder, you are an owner of that business. And the market kind of went crazy last year, year before last, with all of this retail meme trading that was partially fueled by Bitcoin and other excesses that were starting to leak into the market. You had, memes built around GameStop, AMC. There were some other smaller, more thinly traded stocks that were not trading as if they were business. If you look at the prices of those stocks, no fundamental analysis would ever support the notion that they were worth what they were trading at. They had completely disconnected from economic reality, and they were being driven by fund flows. And those fund flows were being driven by social media. So it was herd behavior by investors. If we all as analysts can grasp the notion that stock is representative of business and our ownership of that business, then we should similarly be able to identify any circumstances where that business is disconnected from economic reality. Okay, if that's true, if we can follow that logic train, then there's an opportunity for us to step in and profit from any dislocation between the fundamental value of the business and where it happens to be trading, whether that's due to meme trading or social media or whatever it might be. Anybody watch the GameStop documentary on Netflix? Ryan, you watched it? It was pretty good. If you haven't watched it, you're looking for something to watch on Netflix, check it out. It's worth your time. Okay. Lastly, on this balance sheet, you'll see treasury stock. Treasury stock is what we call contra equity. Contra just means that it's going to function the opposite of the way a traditional equity account functions. So any stock that the management team decides they want to go out into the market and buy back, these are stock buybacks that we've touched on a couple of times this semester, is going to show up on the balance sheets as treasury stock. And we deduct that from the typical equity account.
Like a random question about like shares, so like, what's the point of the company to issue like a class A, B, and C share, and like none of them are like crazy different, like in price or whatever, like I'm looking at like all of the Liberty stocks, and there's like a ton of different share classes for, I have no idea why, I was wondering if you like knew about that.
Did you say Liberty?
Yeah, like Liberty Media, Liberty Broadband, Liberty Sirius Radio.
So John Malone.
I'm a big Malone fan.
Okay, I'm a big Malone fan too, but so John Malone is super familiar with the organizational structure, but what you'll typically find with the A shares, B shares, C shares is an org chart that rolls up to a family or a trust or some other organization that gives somebody like John Malone more control than their shares would otherwise indicate. So you can structure these shares so that they have an economic interest and they have a voting interest. And those two interests don't have to be aligned. For example, Berkshire Hathaway, one of my favorites, they have A shares and B shares. Only the A shares actually get to vote. So if you're John Malone and you want to use the same type of structure, you can say only the A shares get to vote, which allows you to control the company with as little as, I don't know, pick a number. You don't have to have 50% of the economic interest to control the company. You can have as little as 5 or 10% interest in the company and still control all of the decision making inside of an organization. Now that can be a red flag, because it's, if you choose to invest in a company like Liberty Media, you're basically handing over a lot of trust to John Malone. You have to be a big fan of John Malone to invest in Liberty Media, because and that can be okay. I mean, the best society is a benevolent dictatorship.
He's like,
Right?
got a lot of misses lately though. I mean, I respect what he did. He's kind of messed up a lot in the last 5 years, but
Yeah, so
just
just be careful, because if it doesn't go your way, you can't launch a proxy battle or try to kick him out as CEO. You don't have any control over the way that company is being run. That's another great thing to know, because when you all have your own companies and you go public, maybe you want to issue B shares. And if you can, anybody watch We Crashed Apple? That's not a great one. It's an expose on WeWork. It's not an expose. They turned it into a fictional drama, but it's based on a true story. And Adam Newman was the CEO of WeWork, and he turned WeWork into a $50 billion company that IPO'd on the New York Stock Exchange, and then very shortly after that, just absolutely crashed. It was all hype, and it wasn't. I mean, it's incredible. You have to be an incredible salesman to convince publicly traded markets and very smart people on Wall Street that they need to give you $50 billion. That's a good story. If you can tell that story, you have some real talent as a salesperson. You didn't have any talent as a manager, unfortunately, because it was more hype than real business, and it crashed. It's a really great program to watch. He used some of those same mechanisms to keep control of this company for probably much longer than he should. Trying to remember some of the excesses that were inside that story, but the guy paid himself some outrageous amount of money. I think it might have been as high as $50 million, but that number's off, to trademark the word we. So he set up another company. Marketing, branding, they trademarked the word we, or WeWork. And then they sold that brand back to WeWork for $50 million. So the transaction went, Adam Newman, as the CEO of WeWork, steps out of WeWork, sets up his own LLC, trademarks We, sells it back to WeWork. WeWork sends him a check for $50 million. Just, and this is the type of stuff that you can find if you take the time to read the fine print in the publicly traded WeWork documents. You're gonna see this stuff disclosed in the conflicts of interest section. And nobody pays attention to it. I don't understand why. I don't get it. It's unbelievable.
Isn't that embezzlement?
Yeah. I mean, it was wrong on so many levels. Well, I seriously watch the docudrama. It's so compelling. I got my wife involved, and that's not typically the kind of thing that she'd be interested in, but she got hooked. So it's pretty good. Another question. Okay. So that's common stock, that's treasury stock, and total shareholders. And so right there, in a nutshell, that's the whole discussion for tonight's class. So I'll be able to move pretty quickly through a lot of these definitional slides. So we're looking at preferred stock and common stock on this slide. Some of the language that you're going to see, par value, we talked about par value. You're always going to see authorized and issued shares. Authorized is authorized by the SEC. When companies want to issue new stock, they have to go ask the SEC, and the SEC says, yes, you can issue this many shares. Here's the red flag or pink flag or what you need to be on the lookout for as an analyst. Your management is in the process of using funds over time. So they're drawing on either additional debt or additional equity, and they've announced to the public that their plan is to issue new stock to fund some new venture overseas, whatever story they're spending, they need new stock. You need to check the number of shares that they're authorized, because if they're not authorized, they can't just go to the public markets and issue new shares. They're going to have to file a new shelf filing with the SEC and go through an approval process. And that can significantly delay their access to the funds. So in a normal operating environment, it's probably no problem. But here we are, the economy is getting a little rocky. If we were to have another major exogenous shock to the global financial system, they may not have normal, quote unquote, normal access to capital. So that delay can cause some concerns. Just be mindful of that. Issued shares, well, that's pretty self-explanatory. Those are typically the number of public shares that are tradable in the marketplace, minus any treasury shares that they bought back. Accumulated other comprehensive income. I'm going to take a deep dive into that tonight. Retained earnings are all of the total earnings that the company's been able to report over the last, well, really since the company went public and before that, and then treasury stock. Okay, real quick on book value per share and how it differs from market value. This is an important concept. It's not a complex concept, but it's important that we all recognize the difference between book value and market value. Book value is the equity number as it's printed on the balance sheet. That's what the books are. The financial books are income statement, financial statement, statement of cash flow, statement of shareholders' equity. The equity that shows up on the books is your book value of equity. We're going to divide that by the number of shares outstanding. That's going to give us our book value per share. For most companies, book value per share is a pretty relevant number because it gives an indication of the net value of goods and services, really assets that a company has ownership of. So you take all of the assets that a company owns, you subtract off the debt, and that's your book value of equity. Theoretically, we ought to be able to go out and replace those assets If we could replace all of the assets that a company owns. Well, we could replicate that company, all the staff, all the infrastructure, all the technology, all of the real estate. We could just go out and buy that, the identical form of it, so we had people and places and tech stack. Well, we could pop up a competitor. That works pretty well if you're trying to pop up a pizza shop, maybe a little less so if you're trying to pop up a pharmaceutical company. But theoretically, that replacement cost has over time for most businesses kind of mirrored book value equity. So that's kind of a good place to start when you're trying to get a grasp on what a company is worth. It trends better and worse for some industries versus others. That's a litmus test that works really, really well for banks. It doesn't work so well for technology companies. You're looking at Apple, you're looking at Facebook, you're looking at, I guess Facebook is Meta now. Looking at Google, which is Alphabet now. Those companies trade, well, they trade at levels that are typically a multiple of book value that can be 5 times, 10 times, 20 times book value. And that's on account of all of the earnings that they've created over time and earnings power embedded in such an asset-like business. Think about Google. After they bought their service and invested so much in technology and staffing, they were able to accommodate intellectual property, the value of which is such an order of magnitude beyond just the simple components that they put together initially, that their market value per share dwarfs book value, which is the next thing I want to talk about. Market value per share is the stock price, in this case, Johnson & Johnson trading at 129.05, divided by the shares outstanding. So Johnson's market value per share was 129.05. And that compared to a book value per share of 5.75. So J&J certainly does not fit well into that description of company whose book value is roughly going to be market value. That can be on account of, with a company like J&J, pharmaceutical business, that can be an asset-light business. I don't know J&J well enough to know the drugs that drive their earnings, but I would guess a big part of their difference between book value and market value is also on account of mergers and acquisitions over the years. So when J&J goes and they write a check for another business, it's very common to see that the price that they stroke for that M&A activity at a number in excess of book value. So then that accumulates over time. Okay, I talked about preferred stock, I talked about the yield, I talked about conversion privileges and contractual nature of preferred stock. Our authors give us an example of that on slide number 9. This is exactly what it sounds like. This fine print, which you can't really read here, but it outlines the nature of, I think this is still J&J, and their dividend. This preferred pays a 4.25% yield, and it has conversion privileges built into it. So these preferred shares are convertible into common shares. And at some point, if the common stock should rally, appreciate, that's going to be a solid financial proposition to convert those. Touched on most of these points. Authors are talking about treasury stock here. I thought this third bullet point, treasury shares neither have voting rights nor do they receive dividends. That's a good test question. That's likely to show up on some homework or a test. Okay, slide number 12 is one of the more technical points in this module number 8, and I expect a lot of you will probably see it, but I'm going to reinforce the notion of materiality before we delve into minority interests. If you see this, it's probably not going to be material. Now, how do you determine if something's material? Is it big enough to affect your investing decision? Most often with publicly traded stocks, if you see a minority interest, it's going to be 1% or less. If it's more than that, it might be material and you're going to have to go through some of the machinations associated with adjusting the financial statements. What is a non-controlling interest? Well, it's very common for mergers and acquisitions to take place whereby the acquiring company buys 98, 99, some vast majority of the underlying stock. Well, if we buy 99% of another business, who owns the last 1%? The answer to that question is minority interest. It could be anybody. Minority interest is just the name that accountants give for that specific instance. And we need to understand that's going to show up on the balance sheet. We get to the statement of shareholders' equity. We're going to have equity associated with minority interests. And we're going to recognize that and be mindful of it when we're computing ratios like return on equity, leverage ratios, other profit margins, so on and so forth. Okay, and this is how it shows up on the balance sheet. So you have shareholders' equity, just like we walked through, total shareholders' equity, and then we're going to see non-controlling interests right underneath that, or or it might be labeled minority interests, and then lastly, total equity at the bottom of the balance sheet. So our authors pose a question here. Which of these numbers, total stockholders' equity before controlling interest, or total equity after non-controlling interest, would you use if you're calculating these ratios? And our authors answer that question for us, and our authors might be right or they might be wrong. The thought exercise I want you all to go through is, well, what information am I really after? If I own the stock of J&J and I'm trying to compute how much money I'm making on my investment, well, then I probably want to calculate return on equity using the top number there. Because total stockholders' equity is the amount that common shareholders have contributed. So we're going to divide that into $7 billion here on J&J's balance sheet. Leverage ratios, that's what the bank's looking at. If the bank is looking at loaning money to J&J, well, the bank doesn't really care who contributed to equity. They just care about the total value of equity that's been contributed. So they're going to look at the bottom line. Market to book ratio. Typically, investors are looking at market to book ratio. That's a ratio that's used by investors. Investors are thinking about buying the common stock. If the common stock is the relevant analysis, relevant level of analysis, well, then you're looking up a little bit further on the balance sheet of this $7 billion. That's kind of the thought process that you need to be going through, and that would apply to all ratios. You know, what's the use case? What question are you really trying to solve? And that'll determine whether or not you're looking at the total equity before or after non-controlling interest. Okay, let's look at repurchases. Repurchase volume has been absolutely through the roof the last couple of years. That's beginning to change a little bit with interest rates, but it was a very common financial transaction, and has been a very common financial transaction for companies to borrow money because interest rates have been so cheap and deploy that money by buying their own stocks back in the marketplace. And historically, and even in most textbooks, you'll see that identified as a buying signal, as something that's positive, a positive indicator that that company might be undervalued. And it stands to reason, because who knows a business better than its own management? You wouldn't think that a company's management would be buying its own stock back in the marketplace if it wasn't price trade. I mean, that's value destructive. You pay too much money for your own price. If a company's worth 50 and you're buying the stock back at 100, you're just destroying value. You might as well put that money in the fireplace. But if J&J's trading at 125 and it's worth 200, that's a very value accretive trade. You're buying something that's worth a lot more. So management, who ought to know more about the company than anybody else, if they choose to embark on a stock buyback program, that's generally been considered a very positive thing. Now, for all the reasons that we've already gone through several times in this class, I have asked you all to put on your cynics cap and play a little game of find the penny so that you can understand how those buybacks may or may not affect the stock-based compensation and other incentive comp associated with your management team, because it doesn't always work that way. And in the back of your 10K filing, you're gonna see a history. I'm gonna show you a table here in just a minute that will report on the average price that your management teams have bought stock back at over the last few years. So you get to see if they're any good at this. And if you see that they've been consistently buying stock back at a price of $75 for the last 5 years, and now it's trading at $20, well, that's a loser. So you would be right to ask yourself, this management team has never created money for investors in the past by buying stock back. Why should I take it as a positive signal today? So rather than just rely on the conventional wisdom that stock backs are good, do a little digging and find out if your management team has any clue about what they're doing when they're buying stock back. Because it's right there in the 10K file. You can flip to it and see what their track record is. You'd be wise to do so as an investor. This is pretty simple accounting treatment. I'm not going to dwell on it. When we buy stock back, we get cash going out the door and we got stock coming in. That's a debit to, that's a credit to cash and, credit to cash and debit to treasury stock.
Can that, sorry to interrupt,
Yeah,
but
please.
can that be a method to offset your price to earnings ratio as well to help make sure, like for your stockholders to show that you're having consistent growth to do those types of buybacks at a discounted rate?
I'm not sure I understand the question. The basic transaction, if we deploy cash and we take stock out of the system,
Right.
so our price to earnings ratio. So we have price per share in the numerator and earnings per share in the denominator, and now we have fewer shares, so the earnings number is going to go up. So just the simple mechanics of the way that ratio works is the price to earnings ratio would go down if we looked at nothing other than just that simple transaction. When we take shares out of circulation, we would expect the price to earnings ratio to go down.
Oh, okay.
Is that?
Yeah, I was just
Well,
wondering.
rarely do things operate in a vacuum like that because the market sees what management's doing, and generally investors are going to pay up a little bit more. So there's trade-offs associated with that, but in a vacuum.
Yeah, because I was curious if that was a method used to keep their earnings per share consistent across the board so that maybe it helps their stock performance at the end of the year.
It
Book
could,
value.
it absolutely could. If you have stock-based compensation that's linked to earnings per share, and all of a sudden a recession kicks in, and you would expect your earnings per share to decline, well, let's just take some shares out of circulation. And that's gonna buoy that a little bit, and you might find a management team that's using that little maneuver to get themselves paid. It happens. So when I ask everybody to be cynical, those are the types of questions I want you knew going on. Okay, moving on. Oh, here's an example of what I was talking about just a minute ago. As of 2018, this is the second bullet on the slide, as of 2018 year end, J&J had repurchased 457 million shares at an average purchase price of $75.10. We'll just pull up the stock price. Where's J&J trading? How long has it been above $75? And this data goes back to 2018, so it's not relevant to today's trading volume, but that would be the exercise to go through. Okay, slide number 21 is a little bit of a head scratcher, and this is a challenge for analysts, and our authors give us some suggested courses of action. None of them are really great. I can give you my preference, but because of the prevalence of stock buybacks in the last few years and the contra equity status of treasury stock, what you'll see frequently on the equity section of the balance sheet is just like what we went through there with that first slide. You have par value of common stock, you have additional paid-in capital that might have been raised a decade ago. Then you have retained earnings. Then you're going to subtract off any treasury stock. So treasury stock's a contra equity. Buybacks have been so aggressive that treasury stock number can sometimes make the bottom line equity number negative. So because we subtract out treasury stock, the equity values of some of our largest companies in the Fortune 500 are actually going negative. Now, what happens if you see that? Well, there's several ways to adjust for that. Instead of looking at return on equity, which all of a sudden becomes nonsensical. If you have negative equity, you can't calculate a return on equity. You can look up a few lines higher on the balance sheet and focus your analysis on return on assets or return on net operating assets. Another alternative would be to compute return on equity after adding back the treasury stock. So you reverse all those treasury stock transactions as if they never happened. This is an analyst adjustment that requires adding back the shares and also adding back the cash that would have been used to purchase those. I can envision some use cases as an analyst that might make that worthwhile. Number 3 would be to substitute market value of equity for book value. Well, yes, of course. That's not a great substitution because you're already looking at the market value of the equity. Book value of the equity is supposed to give you a different perspective and different information. So you're really just sacrificing that information altogether. My preference is number 1, just because if you're focusing on return on net operating assets, you're focusing on the business as a whole, the equity and fixed income alike. And that's going to give you insights into the true cash flow generating returns that the business offers over time. So what's the quality and strength of the business? If you focus on return on net operating assets, which I think of as return on invested capital, those two terms are interchangeable. If you focus on return on net operating assets, you're really focusing on the quality of the business. And then the financing of the business is a separate and independent conversation. And I don't like to give the management teams credit for financing decisions. I like to assess the quality of a management team based on how well they run the total business. And then financing is another maneuver that you often see management teams use or pull when they're trying to manipulate the accounting associated. Sometimes. Let's talk about stock-based compensation. We're way ahead of the game here just because we looked at this in week 1. But high level and theoretically, I have no problem with stock-based compensation. We can use it to incentivize our management teams. We can use it to retain key talent inside of the business. We just have to be mindful that sometimes it can create incentives that are not aligned with common stock ownership. So if we're mindful of that, then the purpose of some of these plans can do a great job of attracting key talent, to power our businesses into the future. And here are some of the most common incentive-based plans that you're gonna run across. And I expect you've seen some of these already. Restricted stock units, employee stock options, stock appreciation rights, employee share purchase plans. And these are all contractual relationships. Broadly, they fall underneath 5 large categories, but you're gonna have to dig in and read the fine print on any of these offered by the companies that you're working on this semester, because they're all gonna differ in kind from one to another. So Johnson & Johnson's restricted stock units are not gonna look like or behave like Home Depot's restricted stock units. They're gonna have different vesting terminology, they're gonna have different strike prices, they're gonna have different metrics that they're tied to, like earnings per share or return on equity. You gotta do the heavy lifting to find out how each of these functions and what the unique features are. And again, the contractual nature of that makes it extremely challenging. And oftentimes, there's not just one variable that triggers some of the options on those incentive-based comp plans. They might be 5% tied to earnings per share. They might be 20% tied to appreciation in stock price. They might be 50% tied to return on invested capital or margins or revenue growth or so on and so forth. So it's a big challenge to tease all that out and get an accurate read on what's going on and what's really motivating management. And I understand the challenge at hand when I ask you to sort all that out, but I want to get you thinking. I want to get you thinking on what companies are using to motivate their management. Okay, when a company uses stock-based compensation, they're required to expense it. Stock-based compensation doesn't. If I want to incentivize everybody in this class with stock-based compensation, all I have to do is draft this contractual language. I sign it, you sign it, and we're done. Well, that's a real expense for the company because we've just made a future promise. We're on the hook to deliver stock in the future, and that has a real cost. And the accountants say, ASB says that just because no cash went out the door today, doesn't mean that doesn't have to show up on the income statement as an expense. So how do we expense? Well, we use an option pricing model. So if you all have taken derivatives, then you've looked at the Black-Scholes option pricing model, or maybe a binomial method. We're going to use one of those methods to come to some assessment of what those future options are worth. Then we're going to expense those over time in accordance with their vesting schedule. So if they vest over the next 5 years and we've determined that they're worth $1 million, then each and every year for the next 5 years, we're going to expense $200,000 on our income statement. Now, rarely do you see an income statement with an expense line item that says $200,000 cash stock-based compensation.
Could you say that one more time? So you said that you don't don't expense it all at once, you do it over a longer period, almost like amortizing it?
It's exactly like amortizing it. You expense it ratably over the vesting period. So if I promise you $1 million over the next, I promise you $1 million and you get it 5 years from now, but it vests in 20% increments over that 5-year period. Then next year, because 20% of it is vested, now you have rights to it. I'm going to expense 20%. So that would be $200,000 if it's $1 million package. Same thing for the follow-up. I'm going to expense another $200,000. Same thing the following year, and so on and so forth. So that by the time you get to the final year, you've expensed the full options package. And the way most of the corporate America does it, you probably do for a new options package. So to finish that last thought, rarely do you see stock-based compensation as a specific line item on the income statement. Yes, sir.
Employee benefit expense.
Say that again.
Under employee benefit expense.
Yeah, typically it's all lumped together in one employment expense, there's a lot of different, you might see it labeled a lot of different, names. But where do you go to find it? You can typically find it on the statement of cash flows because it's a non-cash expense. So it typically is discretely broken out on the statement of cash flows. So when we're trying to wrap our minds around how expensive these programs truly are, and we don't get visibility on the income statement, we can immediately go to the statement of the cash flows and probably find it there. And then we can oftentimes get more detail about that. So is stock-based compensation cash expense? No, we just talked about that. But it does represent a real cost to investors. What you will see, because it's dilutive, right? If we've just awarded management 1 million in shares, well, the earnings per share number just went down. That's not great for common shareholders. If we all own a business, we don't like that. If we're giving management shares of stock and they're doing their job and earnings are going up, that's probably a good thing because we all benefit. Very common to see management teams engage in stock buybacks for the purpose of counteracting any dilution that would otherwise be the result of stock-based compensation packages. So we got this package, it's for our management team. We know that's gonna put 100,000 shares into the marketplace this year. So to offset that, so there's no dilution, we're gonna go buy 100,000 shares. It's just a stock buyback. Now it shows up as treasury stock. Well, okay. Our authors are making the point here, is stock-based compensation a cash expense? Not really, but we could easily compute it as a cash expense if we wanted to assume that management bought those shares back because we know where the shares are trading and we can make that calculation. We can adjust for that. We're analysts. We can put together a spreadsheet and answer the question, how much cash would we have had to pay to offset that dilution? And maybe management did just that. And if they did, then those expenses are going to show up in treasury stock.
Another question would be if you were doing that stock buyback at market value, but you had provided the employees the stock-based compensation at book value, would you gain? I guess would it? Because I'm trying to think of how that would, if you wrote a contract with your employee and said, we're giving you stock options and the value of that increased to a certain point, would you issue it to them with that in mind of it going up in value or losing value? Or I don't know how to put this into words.
You could, all the terms that you just described would be inputs into your Black-Scholes options pricing model. That model would determine the value of what you had just offered to your employee. You could base it off book value, you could base it off market value, you could base it on some discount to market value. All those terms are going to increase or decrease the value associated with those stock-based awards, stock-based compensation. If it's book value, that value is going to be really high. That's great. That's a really good deal. But because that value is high, it's going to show up in a higher expense line item that you have to book in accordance with GAAP, which is going to drag down your earnings per share. So there's a lot of puts and takes associated with how do we price these, how do we incentivize management, how are we going to have to report them, what's that going to do to our ROE, what's that going to do to our earnings per share. Do we face dilution? Management then has to go through that exercise that we've just been discussing here for the last few minutes. Are we okay with dilution? Do we want to offset that dilution with stock buybacks and add to treasury share purchases? There's no right or wrong answer to any of these questions.
Could it bankrupt the company though? The second, like it almost sounds like it could be a very careful balance, like if you do it wrong, where you issue that value to your employees and then all of a sudden it like offsets your balance sheet.
Typically not, because you're going to set the exercise price and the triggering events, like your management team. We're going to award you so many shares of stock if you can increase the earnings per share of this company by 10%. So there's no dilution at all. There's no such thing as an options package unless earnings go up by 10%. And in that instance, in that outcome, well, you're not bankrupting the company. As a matter of fact, you just enriched everybody that's involved in the equation, which is what stock-based comp is supposed to do. Now, when you think like a skeptic, you're like, I'm an old curmudgeon, I don't believe it until I see it. That's the Vern Cushenberry attitude. But what it's supposed to do is incent management to do their job, and if they do their job, everybody gets paid and everybody's happy and just kind of continues the pace. And some of it functions exactly like that. Okay. See here. I want to get to accumulated other companies.
Are you familiar with Constellation Software?
I don't think so. What is Oscillation Software?
Or they were just like kind of like famous, like the CEO is like very anti like stock stock-based compensation. So it's been like the same number of shares outstanding for the last like 30 years of the company and stuff. Doesn't believe in buybacks either. I didn't know if you had heard of the guy or not.
I like his style. My general stance on those types of things is that they don't add value to the company over time. Which is exactly where we're going next with learning objective number on slide 32. Okay, cash dividends and stock splits. So stock splits is a little bit of a pet peeve of mine. If anybody in class is not familiar with a stock split, we're basically just taking the company, the whole pie. If you think of the company as a piece of pie, then the number of stock outstanding is how many pieces of pie did we chop that company up into? Well, if it's chopped into 5 pieces and we issue a stock split, that's 2 for 1. It just means that we now have 10 pieces of pie, but the company's the exact same size. So why would you engage in a maneuver like that? To your point, I don't know, I have a little bit of a distaste to it because you have to pay the bankers to do this and it's expensive. But the reason that most companies give for stock splits is that they want to keep the price of their company in a tradable range. And if you can keep the price of your company in a tradable range, you're going to attract more investors. And if you can attract more investors, you're going to be able to sustain a higher price to earnings ratio and other trading multiples. There may be some proof to that, but I think companies like Berkshire Hathaway have proven that theory in spades over time without ever having done a stock split. 1 share of Berkshire, I think, cost you $500,000 at this point. And there's nothing wrong with that. There's so much fractional trading going on in Wall Street right now. I think that the latter reason kind of falls apart too. Nevertheless, it still happens and we need to know how to account for it. It's really pretty simple. I'm going to buzz through the accounting because I want to get to other comprehensive income tonight. So I'll let you review the accounting for that on your own, but just know that the number of stock certificates typically doubles. It doesn't have to be a 2 for 1 stock split, but it can be a 3 for 1 or a 4 for 1. Whatever that ratio is, you're just going to adjust all the major categories of your equity on your balance sheet, and that's the adjustment. Now, management teams can also issue what is called a stock dividend, which I view as an even more transparent. If they don't have the cash to pay a 5% dividend or whatever it is that they normally pay, maybe it's $1 a share. Well, you'll see management teams issue $1 of stock per share. Well, if we all own a business, if we all own 1 share of a business and management says, I don't have enough money to pay the dividend, so I'm just going to give you all another share. Now we all own 2 shares of the same business. So what? That's nothing more than a behavioral mechanism, gamesmanship for trying to convey the notion that the company is in good health, when I would argue that more often than not, that's probably a pink flag or a red flag. Okay, Accumulated other comprehensive income, I want to go through each of these categories here real quick, answer questions. Try to add a little bit of color. These can be very major sources of value, big swings in the accounting, foreign currency translation adjustments. We talked about this a little bit in module 4, I think it was. Most of the companies we're looking at have significant operations overseas. So at the end of the year, we have to translate all that business that a company is doing in euros or pounds or NIMBY or the Australian dollar. We have to translate all those balance sheets back into US dollars. So we can report them to the SEC, get taxed accordingly, and then also issue those financial statements on to investors in a language, in this case, US dollars, that everybody can comprehend. But we are not actually repatriating those funds in most instances. And we are not actually trading US dollars for British pounds or vice versa. So how do we go about doing that from an accounting perspective? Well, we have to use the exchange ratio that was prevalent during the period of time that those monies were earned. So typically what we're going to use is the average ratio for the income statement and the end of period ratio for the balance sheet. Now, if the dollar has been accumulating, then we're going to translate all of those foreign currency numbers at a lesser rate. If the dollar has been depreciating, we're going to translate all of those foreign currency numbers at a greater rate. So let's walk through this. Statements are translated into US dollars. This is bullet points number 2 and 3 are the ones to star there, because this concept can be a little bit difficult to grasp, but the better authors give us the cheat sheet here. The strengthening and weakening of the US foreign currencies results in decreases and increases to the value of US subsidiaries. Those gains and losses are reported in other comprehensive income because they can be huge, and because foreign currency gains and losses have a tendency to offset as we move from year to year to year. One year the euro will rise relative to the dollar, the next year the dollar will rise relative to the euro. So if we suppress the reporting of these gains and losses on the income statement, we don't run it through net income. We run it through another category called comprehensive income. Over time, it has a tendency to kind of even out. That's the theory. Now, the US dollar relative to our foreign trading partners is strong and has been strong for a couple of years now, really since COVID. So you've seen some of these, well, I guess some of these losses, some of the weakening to translation losses begin to compile on some of the books. Now, if you think that's going to continue, you can take a stance as an analyst and build that into your theory and make the case that your foreign currency translation gains and losses are, I'll just make that a big part of your buy theory or sell theory. And there's a lot of extremely sharp macro analysts on Wall Street that do exactly that and get paid very, very well for doing it. Now, generally speaking, if that's your area of expertise, you are not looking at individual companies. You're probably working for a major bank, like JP Morgan, or some derivatives hedging desk, or some hedge fund, and that's your sole source of expertise in daily trading. I would not typically encourage you to draw on that as a part of your thesis for this class, but it's important to know that goes on. Okay, category number 2, employee benefits plans. The gains and losses associated with defined benefit plans are reported in other comprehensive income, because if you're trying to keep track of all of the liabilities that you owe to a whole generation of retirees, that number can number into the tens of billions of dollars. So I think I shared this story with you, but my grandfather, who died in 2002, spent his whole life working for Phillips 66, and he accrued a pension. Not only did he accrue a pension for himself, but he accrued a pension for his wife, my grandmother, who's still alive and will turn 91 in another 2 weeks, she still draws on that pension. So imagine the accountant. You're Phillips 66, you're the CFO, you have to compute the liability associated with sending a monthly check to my grandfather who retired in 1985. He got paid that monthly check from 1985 to 1990 to 1995, 2000, 2005, 2010. He died in 2002, but my grandmother kept drawing on it. So now she's getting a check from 2010, 2015, 2020, 2023, still getting that check in the mail every month. How do you begin to compute the value associated with that liability when you multiply that experience across 10,000 employees? Well, now you probably owe $20 billion. Well, if you owe $20 billion and you've been prudently setting aside funds for that liability over time, like the Pension Benefit Accounting Association requires you to do, then you have an investment account that funds those liabilities. And that investment account is 30, 40, 50 billion dollars large. The largest defined benefit investment account, I think, is Boeing. I think theirs is about 100 billion. Don't quote me on that. But imagine if you had an investment account worth $100 billion and the market goes down by 18% like it did last year. Fixed income went down by 18% and equities went down by 18%. There's no place to hide. You just had an $18 billion loss. Well, how do you run an $18 billion loss through the income statement? The answer is you can't put an $18 billion loss on the income statement unless you want to make every other line item on the income statement. It's just silly. Now that's everything else on the income statement would be dwarfed in comparison and become useless. So our accountants, as accountants, we recognize that fact and put changes in employee benefits plans in the statement of other comprehensive income. Gains and losses on marketable securities, not equities, but certain debt securities are run through other comprehensive incomes. Debt securities held to maturity. We're going to go into that classification in more depth in module 11. Gains and losses on derivatives. These can be very, very big. Think about a company like Southwest Airlines. Their largest single expense line item is jet fuel. Well, they hedge the cost of that jet fuel so that when jet fuel rises, the value of their derivatives contracts associated with that will similarly rise. Well, for a company like Southwest Airlines, like billions and billions. So that be system down in other comprehensive income. This is how you're going to see that reported on this is the 10K, this is the statement in the back of the 10K. You're going to see how equity fluctuates according with each of these major categories, and there are more. This is just a sampling of the largest 4 or 5. So find that table in your 10K, get to know it. If there's anything unusual in there that you need help with, let me know. Okay, there's 2 other learning objectives in this module. Convertible securities. I'm going to let you walk through that on your own time, and the accounting for convertible securities, because it's not complex, but spend a few minutes with those slides. And then very lastly is earnings per share and the dilution associated with certain options packages. There's nothing tricky about that either. So I'm gonna call it a night and put 1 minute and 45 seconds back into your pockets tonight. You're welcome. Unless there's something else that y'all need to cover. Okay, well, thanks, gang. Appreciate it. Good to see you.
And we have class next week.
We won't meet in person next week, but the exam is over. So take that. You're ready. Thanks, girl. You got a long bus ride.